Hello, everyone. My name is Suresh. I'm a buyer's agent from Ethical Growth Buyers Agency. So, as you guys know, if you don't know what a buyer's agent does, we specialize in buying properties as opposed to selling properties. So, we actually do a lot of buying, purchasing in interstate across Australia, based on the requirements from the potential buyers. And then the value add addition, what we do is you don't have to travel around and do a lot of inspections yourself, and then understand which area is better and stuff like that. We do all the legwork for you. We do a lot of coordination with tax agents, mortgage brokers, property managers, or settlement agents, conveyancers, lawyers, everybody. So your job is made very easy for us by working with us. By you give us the requirement, and we work on a strategy for you, and then we buy on behalf of you. And yeah, over to you, Andy.
Perfect, Suresh. So my name's Andrew. I'm from a company called FTC. We are a tax advisory firm specializing in SMSFs, companies, and also asset protection and structuring. So that's sort of what we do, and that's how we fit into the picture when it comes to property investment.
Excellent. Andrew, like I've got like few questions, commonly asked questions by my buyers whenever I have my discovery sessions or strategy sessions. So probably like some of the insights what you provide from a taxation perspective would probably help them out. So the first question, and I would jump in straight is, can you just provide how the taxation is done and how an individual investing in a property is going to help them save those taxes, because we always see a lot of ads saying that, oh, you're paying 45K, 50K per annum, and then by investing in property, we can make it to zero. Okay, though it's a bit of exaggeration, but having the facts, by a person, by an expert like you, would probably help the buyer to understand it more from a taxation perspective.
100%. So whenever I speak to clients about purchasing investment properties or thinking to do it, I think the first thing to do is probably to talk to your tax agent or advisor, just because all those examples you probably saw on Instagram, Facebook, they are very they're definitely available. They can happen, but it's on a very specific type of circumstance. So if you're on a lower income, then the tax savings from purchasing an investment property are probably not as big as what you think it is. So I think before you start, always talk to your tax advisor or accountant will then explain to you the process of actually the process of what an investment property entails when it comes to taxation. So generally speaking, what people like to do is to lower their tax. So that's 100%. And property is a vehicle where it actually allows you to lower your taxation. But the thing is, lowering your taxation only comes when the property is in a loss. So if the property is losing money year on year, that loss then comes into your taxable income, and that lowers your taxable income, effectively giving you a tax refund. So I think it's one of those things to understand. Yes, you are getting a tax refund, but it also means that the property is actually losing money. Of course, on the other side of that, you'd hope that the property prices are increasing to offset that loss. And especially over the last few years, that's what's been happening. Price growth has been phenomenal. So prices have been ramping up very quickly. So investors are willing to take on that tax loss because they're going to get it on the other side when they sell the property.
Excellent, excellent. See, this is one of those questions. One of the things what I actually, as part of my strategy, discuss is what is the customer, what do the client wants? Okay, do they want a high cash flow property or a high capital growth property? Because what we see is, from as a buyer's agent perspective, when we put up a strategy, we don't want the buyer to stop at property number one or property number two, because we want them to keep buying properties, because the ultimate goal for anybody is to retire early or not have freedom like by buying properties, right? So the advice, what is the advice you're going to give? But do we actually aim for positive gearing properties or high cash flow properties, or we work on work on reducing taxes?
Look, to be honest, it's a very individual circumstance, but usually,
Yep.
say for example, if you're on a low income, say you're earning 50 grand per year, you won't be able to go buy a property, say, that's really highly negatively geared, because the bank won't give you enough money to purchase that property. So where we're looking in New South Wales, I mean, from the Northwest area, say you're looking in a suburb like Schofield.
Yeah.
Schofield's has, say, a median price of about 1.5 million. if you're on 50 grand per year, you probably won't be able to purchase that property via loan serviceability. So the banks will stop you there. So if you're on a lower income to start with, maybe it's probably better to start buying properties that are more positively geared or closer to zero when it comes to net cash flow, just because it will help you afford the property. If the property is in a very negative position and you're on 50 grand per year, you probably won't be able to afford it because you still want to live, you still want to enjoy your salary, you still want to do all of that. If you go something that's too highly leveraged with too much debt, yes, you'll get the negative gearing, but it's also going to impact your personal cash flow.
Excellent. That's good. I think that really is a good segue. The next question I'm going to ask is, see, how does capital gains tax work, right? Because see, like I know like few of them are pretty much financial literates who actually understand all those aspects when we're talking about, but a lot of people who doesn't understand the real meaning of capital gains. Do that like it's always about anomalies everywhere. So you want to give some clarity on that as well?
Yep. So capital gains tax is a good thing. A lot of investors don't want to pay it 100%. They don't want to pay tax. But if you're paying capital gains tax, it means that you have made money from your investment. So you have sold it for more than what you've purchased it for. So there are certain exemptions. For example, if you keep the property for more than 12 months, you get a 50% discount on the gain. So there are exemptions like that available, but they're very determinant on individual circumstances.
Gotcha.
So if you're paying capital gains tax, you've made money. So I think if you're deciding whether to sell a property or not, I think don't let the capital gains tax impede that decision, because if you're paying it, you're actually in a good position.
Absolutely, absolutely. So I've got another question. So what is the advice you going to provide to the property investors from a record keeping perspective? Because like, see, when you buy properties, like one property is fine when you're buying like one or two or three properties. There's lots of bills you are paying as part of maintenance of properties, and then what records they have to keep, and then what's the best suggestion you want to provide from a taxation perspective to avoid any kind of issues with the ATO in the coming future.
100%. So with the ATO, the record keeping is just like your personal tax return. So you also need to keep receipts for a number of years. And if the ATO decides to audit you, then you'll need to produce those receipts, whether they're for an investment property or not, to justify those expenses. So I think the best way, and this is what I do personally for myself, is for the property that you have, set up its own bank account. If it has its own bank account, get the real estate agent to pay the rent into that single bank account and pay all the expenses from that bank account as well. So
Okay.
things like rates and water bills and all that sort of stuff, usually they send it to you electronically. So you'll have a record of it somewhere in your emails. But if you pay it from a singular bank account, it just makes the reconciliation process a lot easier for your tax agent at the end of the year, because you can just log onto your internet banking, get a CSV download, and just send it to your accountant, and they'll use that to work out what tax is payable or refundable based on that CSV. So of course you still need to maintain receipts, but that just gives you a guideline of what you've spent and how much you've made throughout the year.
Okay. Excellent. All right. So one question is, see how obviously like a lot of people what I've observed is they don't realize, they don't come to tax accountants all the time, okay, because people have got used to use the government portal to lodge tax returns, right? So what do you think the emphasis you're going to put on reaching out tax accountants in the first place, especially when you're trying to build your portfolio, right? So what is the difference you're going as a tax accountant is going to provide for an individual buyer from like to really reach out to tax accountant? Like again, I said you like the reaching out tax accountant is a bit it's slightly expensive from a individual who has never invested, because they just go to like either they do taxes by themselves or they give you like a cheap $100 tax refund guy, right? But they have that kind of a mentality most people, but they have to do a shift, okay, in understanding. So, what is the benefit? What are the benefits you're going to offer from a tax accounting perspective?
100%. So when it comes to spending money on professional services, it always comes down to who can provide you the best value. So yes, the refund is one component, but I think if you find a tax advisor or tax agent who explains the process to you, and helps you along the way, I think that's also a big positive. Just because if you're just solely looking for tax refunds and trying to get the most out of your tax return, then the whole investment journey is always going to be um, geared towards getting the maximum amount of refund. But in actual fact, as you sort of grow wealth and you become bigger and your properties get paid off, you start forming positive cash flow. So eventually you're going to be paying tax to the government, even though initially you may be negatively geared at first. So I think that's where maybe a tax advisor can, strategize with you and go, hey, it's probably, it's time for you, this part of your journey for you to buy a negatively geared property rather than this type of property or that type of property, and they can help you along the way. So it always goes back down to the saying, you pay peanuts, you get monkeys, 100% in all industries, whether the lawyers, the accountants, the buyers agents, it's always trying to find someone that understands it fully and that can share and explain it to you as well.
Excellent. All good. Thank you. I think that's pretty much the questions for me, Andrew.
That's okay. No drama at all. So whereabouts do you focus buying properties from your end, Suresh? Like, are you more regional, metro? Like, where do you think are the hotspots at the moment?
So, Andrew, like what I see at the moment is due to Sydney being the metro is already hit up the highest, median, 1.5 being almost a median price in Sydney. So my area focus is more investments, and so which means I'm targeting interstate and the regional as well, which pretty much under 650 or 700 mark, right? Because I want to give the value. If you understand the property clock, the famous property clock, where you actually buy at 7 o'clock, okay, because you have a room to go to 12 o'clock, which means that if you put 700K, I'm looking at suburbs, hotspots where you can still make money where it goes to reach 12 o'clock. Okay. At the moment, what I see is due to high interest rates, whatever, Sydney, if you buy an investment property of $1.2 million, let's say, you actually get like maybe $4,500 rent per month. But you're paying almost $8,000 to $9,000 in mortgage payments. So the gap is too high at the moment. So even though Sydney is a good market in the long run, in the current market, it's not advisable. Is what I've observed in majority of the cases. Still, you can find a property of a lower price, but again, my area of focus is specifically in Perth or Adelaide, Brisbane, some parts of regional New South Wales too,
Okay.
and regional Queensland.
Okay, so you touched on interest rates. Where do you reckon they're going to go?
As you would have seen the article today, but the NAB actually has changed its cash rate prediction from a 0.25 basis increase to on hold, which actually it joined all the other four banks as well. Okay, so and also if you go by their predictions, they are saying that maybe there'll be cash rate cuts from September onwards. Okay, I think if you look at the macroeconomics as well, the US elections coming up in April, and which can actually have a knock-on effect on us. I mean, like if you look at all these articles, published by lots of economists, and financial analysts, we already hit a peak. Okay. Okay. If you look at the CPI as well, in the November, what they released, it's around like 4%. And it was like 8% a year ago last year, right? From 8% to 4% is also an indication where it's not good for the economy because the prediction shows that we are entering into recession or people are going to lose jobs or whatever. But the cycle is actually is peaked down, right? So which means that there's only one way up, which I'm also assuming that the interest rates are going to go down in the next 6 to 12 months time.
Okay. Okay. So, and where do you see housing supply? Like, do you see, which states do you reckon are going to grow better than others?
See, if you ask me the housing supply, it's an issue across all the states in Australia, right? So if you've seen the commitment by Labor government that they're going to build 1.2 million houses, right? In the next 5 years, that's an indication that we are under supply everywhere. Okay, especially the metros, obviously, like Sydney and Melbourne. But the amount of immigration is going to happen in the next 2 to 3 years. Like they're expecting around 750,000 people coming to the country. But if you look at the current statistics, with the number of people currently in the country, we are already short by around like 65 to 70% of the dwellings. Okay, so And also, I've seen an article recently that currently there are only 30,000 approvals by the councils across the country, which means that 1.2 million houses they want to build, but the rate at which they are providing approvals to build new houses is very low. Okay, it's going at snail's pace. So the supply issue is across the board. Okay, but where we have to see is where the infrastructure funding is happening. Okay, it's not just about supply, because if you look at some mining towns in the northern Perth region or North Queensland, okay, mining towns, there's always supply is low and a lot of demand, but it's temporary. Okay, because we don't know if the mining boom is gone. Okay, you lose a lot of money. We've seen it happening at least 2 to 3 times in the past in few hotspots. So it is very important to really identify the correct suburbs where it's going to have capital growth, and that's where we will come at the moment.
Okay. Okay. My last question for you is: so would you go more new build or existing?
See, new build is a good aspect. Okay, to be honest. Okay, when I say new build, it's established or something which is like a housing and package. Okay.
So something more new. Like, would you go for something newer or something that's 15, 20 years old?
So I would say I'll go newer, okay, because as you know, like it's tax depreciation advantages, you get the max depreciation for the first 10 years. Like Anthony can explain a bit more on that. Uh, but it's very hard to find those kind of properties because as an investor, nobody wants to sell within the first 10 years of a property of a new build, okay, because they want to get the maximum depreciation claim, right? So that's one thing. But it's harder to find those kind of properties. But again, depending on the strategy, right? So there are different strategies what we adopt for different clients' perspective. Let's say like a buy and hold strategy perspective, or somebody wants to tax depreciation only. Somebody wants cash flow. It all depends on the strategy what the customer wants. Okay, some people just want to make quick money. Okay, they just want to get in, make money, and then just wind off and then go. Right. Some people wanted to actually have a longer view, longer term development where they want to develop, subdivide, okay, and they don't mind buying an older property, okay, where we can buy a bit more cheaper, okay, but they're able to actually finance the property, that's crucial. Newer builds are high cost, obviously, but again, my what I say is it depends on the strategy and what we're going to employ for individual and based on circumstances.
Okay, beautiful. Okay,
Yeah.
I think we'll leave it at that for
Yeah.
now, and we'll probably catch up next week and probably do another video for everybody as well.
No, yeah. Thanks, Andrew. Thanks for your time and thanks for your insights. And then it was really helpful for my buyer as well.
Likewise, thanks, Suresh.